Good afternoon and welcome to Bulls, Bears, and the Bell. Thank you for joining us. Today we're doing a deep dive into the daily market intelligence report for October 2nd, 2025. And what we found is, well, it's really a picture of a market it's less one cohesive thing and more like a tale of two totally different realities playing out at the same time.
It really is a striking paradox, and that's, the core mission for us today in this deep dive. You've got the U.S. equity markets, the S&P 500, the NASDAQ, the Dow hitting these, frankly, impressive new all-time highs, record highs.
Yeah.
But then you look over at Washington, and it's just complete gridlock.
Yeah.
The government shutdown is deepening. And underneath it all, the economic data is showing some pretty clear signs of slowing down, deceleration.
Yeah, exactly. So the central puzzle, the thing we really need to explore, is how these markets can show what the report calls this remarkable resilience to political turmoil.
Yeah.
The feeling you get is that investors, they're just not tethered anymore to the near-term noise from Capitol Hill, or even the subtle slowing in the economy. It feels like they're living in this kind of separate technological growth reality. And it seems driven by just one thing.
And that reality, that's what we're calling it. AI enthusiasm eclipsing Washington gridlock. That's the dominant narrative right now, no question.
Yeah.
So our goal here is to really break down the specific forces at play. We need to look at the sheer size of these record numbers, also the extremely narrow leadership that's driving these gains. That's key. Then there's the global ripple effects, stemming from all this capital spending in Silicon Valley. And maybe most importantly, the massive concentration risk that the market seems to be, choosing to overlook right now.
Okay. Before we really get into the psychology behind it all, let's just anchor ourselves with the numbers, the cold, hard numbers that show this resilience.
Right. So despite all these headwinds we mentioned, shutdown, slowing down of the benchmark S&P 500, it closed up 0.34% at 6,711.20. That's a new record high.
Okay.
The tech-heavy NASDAQ composite, which, is the most direct beneficiary of this AI enthusiasm we'll be talking about.
Yeah, naturally.
And naturally led the way. Gained 0.42%, closing at 22,755.160, another record.
Right. And
even the Dow Jones Industrial Average, it managed a modest gain, 0.09%, closing at 46,441.10. So it's a clean sweep, new records across the board. But, and this is the crucial part, the engine driving this whole thing forward is incredibly focused, very narrow.
Right. Let's dive into that engine then. What makes this the Teflon market? Where all the bad news about politics or the economy, it just slides right off, fails to stick. The main catalyst here, it feels like it's not just hope. It's this narrative of huge, immediate capital investment pouring into artificial intelligence, into the AI sector, signaling growth way out into the future.
Yeah, and what really stands out in the sources is the scale. The sheer validating scale of the money involved. This wasn't just abstract talk yesterday. It started with a really concrete, honestly eye-watering corporate valuation figure, OpenAI.
Yes.
They completed a share sale, and that sale catapulted its valuation to an absolutely astonishing $500 billion.
$500 billion for a startup. I mean, just to put that number in context for you listening,
yeah,
that valuation puts OpenAI in the same league, the same really rarefied air as some of the most established massive companies on the S&P 500. Companies like Visa, maybe ExxonMobil. It took Apple decades, literal decades, to get to that kind of scale in the public markets. OpenAI just did it privately. That signals this just immense, almost unprecedented private market appetite. Real conviction in the future dominance of AI.
And that private valuation, it then translated directly into public market excitement. Because it wasn't just the number, it was the news around their actual physical infrastructure plans. This signaled a major multi-year industrial cycle, the kind of long-term planning and spending that investors just crave.
You're talking, of course, about the details that came out around the OpenAI Stargate project. What exactly did the market learn about this partnership, and why is it so significant beyond just like a quarterly earnings boost?
Well, the Stargate project, see, it isn't just about building another data center. It's framed as constructing a whole new computing paradigm. The news confirmed this really strategic partnership with the South Korean semiconductor giants, Samsung Electronics and SK Hynix. And this is a commitment to just colossal foundational capital expenditure. We're talking billions upon billions being deployed globally, all to build the specialized computing architecture needed for the next generation of these generative AI models. Is basically a multi-year economic tailwind for that whole supply chain.
Yeah, and when you have news signaling that kind of massive long-term financial commitment, well, it's no surprise that the stocks building the picks and shovels for this gold rush are the immediate winners.
Absolutely. The U.S. chip makers felt that energy right away. NVIDIA, obviously the leader in designing AI GPUs, it rose 1%, and analysts were citing its advance as the single strongest upward push on the entire S&P 500 for the day.
Just one stock. Wow.
Yeah, and other key players, foundational players in that AI ecosystem, like Advanced Micro Devices, AMD, and Broadcom, AVGO, they also climbed significantly. AMD was up 3.5%, Broadcom up 1.8%. This rally, fundamentally, it's rooted in the promise of AI and just the colossal spending that it requires.
Okay, but here's where I have to push back a little bit, or at least ask the tough question. When we look at the data, these AI stocks, they are carrying the entire market on their backs. It feels like it anyway. Doesn't that overwhelming power, doesn't that translate directly into its greatest risk? Which is concentration. We've seen these narrow rallies before, haven't we?
We absolutely have, and that is the vulnerability. We need to be crystal clear about that. This rally is highly concentrated. It really is just a handful of technology companies defining the entire index performance day after day.
Right.
And when the market's whole trajectory hinges almost entirely on this one single dominant growth narrative, well, you create immense systemic risk. Because like we're in a two-speed market. One speed for AI infrastructure, warp speed, and another much slower speed for pretty much everything else.
And if the market were truly confident, like broadly confident about the economy in the future, you'd expect risk appetite to be pretty widespread, wouldn't you? But we don't see that. That caution, that sort of broad fear, it's visible elsewhere, right? Like in the demand for safe assets. It's the perfect contradiction, isn't it? You see the simultaneous strength of these tech stocks, which are, let's face it, the highest risk, highest reward plays out there. And at the exact same time, safe haven assets like gold are persisting near record highs, around $3,850 an ounce. So investors are simultaneously taking maximum risk in one tiny corner of the market and then hedging aggressively against political and economic catastrophe in another. This proves the risk appetite is highly selective. It's not broad at all. And if that AI narrative falters, even slightly, well, there's very little else holding this market up right now.
That contradiction you mentioned, it's perfectly framed by what's happening, or maybe what's not happening, in Washington. You've got AI companies planning these infrastructure cycles years, decades maybe into the future, while the U.S. government literally cannot seem to plan beyond the next day. The government shut down. It entered its second day. The Senate's in recess. There were threats of large-scale firings of federal workers just looming. And this isn't just, political theater. It has immediate, measurable economic consequences. First off, the sources are projecting that for each week this shutdown drags on, we could see a potential loss of maybe 0.1% to 0.2% from quarterly GDP.
Which sounds small week by week, but
it adds up.
Yeah.
And more than that, a prolonged standoff, it starts to really degrade consumer confidence, business confidence. It dampens investment, dampens spending across the board.
And crucially, the reason for this gridlock, it feels systemic now, doesn't it? We're not just talking about abstract disagreements over policy points.
No, not at all. The core friction that's driving this particular shutdown, the thing that has paralyzed Congress, it really stems from these, frankly, irreconcilable differences over discretionary spending levels. You have conservative factions demanding really steep cuts to non-defense domestic spending. Meanwhile, moderates and the opposing party are pushing back hard, especially on funding for things like healthcare, climate initiatives, basic infrastructure.
Right.
And the market sees this political inability to compromise on just fundamental budget mechanics. It sees that as a long-term risk to stability. But as we said, right now, the AI noise is just louder than the budget threat noise.
But the more critical consequence, especially for our deep dive today into the market, is this data blackout. What essential information are we actually losing because of this gridlock?
Well, the shutdown has already delayed the release of the weekly jobless claims report. That's usually a Thursday morning staple.
Okay.
More critically, it's now threatening the timely release of the really highly anticipated September non-farm payrolls report. That's, the most important monthly gauge we have of labor market health. And it also threatens mid-month inflation data releases too. CPI, PPI.
So what does this environment, this statistical blindness, actually mean for the Federal Reserve, for the FOMC, an institution that tells us constantly, repeatedly, that it is unequivocally data dependent?
It means the Fed is essentially operating in a state of, you could call it self-imposed or maybe politically induced fog. They are, as the saying goes, flying blind as they approach their late October interest rate decision.
Which is coming up soon.
Exactly. And historically, these periods where the Fed lacked clear data, they've often led to policy errors, either tightening too much or, maybe more relevant now, easing prematurely.
But the market, again, it isn't waiting for the data, is it? It seems to have completely priced in a near certainty of a Fed rate cut this month. And this conviction, it was only reinforced by that weaker than expected ADP private payrolls report we got on Wednesday. That showed a surprising contraction, right? 32,000 private sector jobs lost.
Yeah, lost 32,000 versus an expectation of a 50,000 gain. So a big miss.
A huge miss.
And you're right, the market narrative is totally entrenched. The CME FedWatch tool, which tracks futures pricing, it indicates pretty much a 100% probability of a 25 basis point cut at that late October meeting. The market is acting as if the economy is already well into recessionary territory, and the Fed simply must act. No questions asked.
Okay, but wait. If the market is that convinced, like 100% convinced of a cut, what happens if the data that does manage to trickle out is actually resilient? What if the non-farm payrolls report, assuming it eventually comes out, actually surprises to the upside? Is the Fed really strong enough, brave enough maybe, to defy a 100% conviction expectation from the market?
That is the policy risk, distilled right there. The choice facing the Fed is, frankly, excruciating. They're under immense pressure to cut rates, as the market expects.
Right.
But doing that without full data justification, that risks a serious inflationary error if the labor market actually proves stronger than that ADP report implied.
Right.
But conversely, if they hold rates steady, maybe because of the lack of clear evidence or maybe because some surprising data comes through, they would completely defy this deeply entrenched market expectation. And that defiance would almost certainly trigger a significant sell-off. Massive volatility. The market might interpret the Fed's inaction not as prudence, but as an unwarranted, uncalled-for tightening. So the shutdown has effectively handcuffed the Fed's ability to make what you'd call a rational, purely data-driven decision. They're caught.
Okay, let's shift our view outward a bit. We saw how AI fueled NVIDIA here in the US, but did that massive capital spend, did it trickle down globally? Let's focus maybe on Asia first and the global market picture, which seemed pretty mixed otherwise.
Yeah, the global impact was actually dramatic, but very specific. Focused right where that AI supply chain touches down. We saw the direct traceable effect of this US-led capital expenditure playing out in Asian markets. South Korea, for instance. Their KOSPI index leaped an impressive 2.7%, hit a new record high.
And the driving force there was clearly localized, right? Tied directly to the companies linked to that Stargate project we talked about.
Precisely. The direct catalyst was that announcement, OpenAI partnering with the South Korean semiconductor giants. That news immediately boosted shares of Samsung. It climbed 3.5%. And SK Hynix, they soared a remarkable 9.9%, almost 10% in a day. Yeah, and this isn't just, a fleeting stock market boost. It's confirmation that these massive, long-term U.S. capital expenditures in AI, they're generating real economic activity, real wealth, substantial stock market wealth, in allied nations that have these advanced manufacturing capabilities. This AI theme, it's now a major factor in global macro strategy. You had to track it.
And if we bring it back home, the sector performance divergence within the U.S. market that really reinforces the narrow leadership point we discussed earlier. Who were the clear winners and, I guess, the obvious laggers yesterday?
The divergence is pretty stark when you look at the sector table. The clear leaders were, well, no surprise. Technology up 0.25%, and materials up 0.54%. They benefit directly from the demand for components, raw materials, everything needed for building out AI infrastructure. Consumer discretionary also showed some relative strength. And that's supported by, actually, a key piece of maybe good news in this otherwise cooling economy, wage growth. It continues to outpace inflation, which gives consumers some real discretionary income to spend.
Right, but the laggards, they tell a powerful story too, don't they? It seems like either interest rate sensitivity or just kind of apathy for the defensive stocks.
That's exactly right. Real estate was the worst performer, down 0.78%. It's extremely sensitive to interest rate uncertainty, potential hikes. Even though the market's actually expecting cuts, the uncertainty hurts. And the classic defensive sector, consumer staples, was also down 0.45%. It just reflects that in a market totally driven by these explosive growth themes like AI, investors are just choosing to ignore the slow and steady defensive plays right now. No appetite for it.
Okay, let's talk about two areas that lag that might seem a bit counterintuitive: energy and financials. Why was the energy sector weak? It was down almost 0.5%, 0.49%. Why, when the economy, at least the AI-powered part of it, seems full of momentum?
Yeah, the weakness there was really driven by the commodity side, not by the stock market's growth narrative, if that makes sense. WTI crude oil prices, they fell again, hit a 4-month low, dropped below 61.1 as a barrel. And that's amid these persistent worries about global oversupply.
Okay.
So when the underlying commodity price falls that sharply, it just pressures the profitability and the whole outlook for the entire oil and gas sector. It doesn't really matter how excited people are about AI somewhere else.
Got it. And financials. They were also in the red, down 0.43%. This seems like the biggest paradox, right? Because there's that near 100% expectation of a Fed rate cut. Why are banks falling when easier money is supposedly just around the corner?
Yeah, this one requires understanding a bit about how banks actually make their money. It's about the yield curve. We saw really strong buying pressure on long-term treasury bonds yesterday. Investors were seeking safety, right? And bond buying pushes those long-term yields down.
Okay.
Banks operate on what's called net interest margins, or NIMs.
Mm.
You can think of NIM as basically their profit spread. They borrow money short-term, often at those lower Fed influence rates, and then they lend that money out long-term. Think mortgages, business loans, and those are often tied to longer-term treasury rates.
Right. So banks borrow low and lend high. The difference is their profit margin.
Exactly. That's the core business.
Right.
So when long-term treasury yields fall, like they did yesterday because everyone was buying bonds for safety, that profit spread, the DNM, it gets compressed, squeezed.
Oh, okay. Makes sense.
And since NIM is the primary engine of bank profitability, that bond buying pressure ultimately hurts the financial sector, at least in the short term.
Yeah.
That leads to the sell-off we saw. Even though, yes, there's this broader anticipation of a Fed rate cut eventually down the line, it's a really key example of these complex cross-currents that can defy simple market expectations.
Okay, now let's shift gears completely. This is where it gets really compelling, I think. Moving from the broad macro themes to the individual stock stories, the ones that really illustrate how quickly disruption and innovation are happening right now.
Okay.
What was maybe the most surprising single stock story from yesterday? The one that highlights how fast some traditional models might be collapsing.
Well, we saw some immense volatility driven by very specific catalysts. On the upside, there was Taysha Gene Therapies, TSHA, skyrocketed, a remarkable 45.3% gain. The catalyst was purely a regulatory win. The company got breakthrough therapy designation from U.S. regulators for one of its investigational gene therapies. And that designation is huge because it significantly expedites the whole development and review process. It dramatically shortens the path to market and potential revenue. So big news for them.
Okay, but maybe the more structurally relevant news, the one with broader implications, was that disruption within the financial services world. Fair, Isaac Corporation, FICO, the company behind the credit score, their stock jumped 23.20%. Best day in years, I think.
Yeah, the FICO news is a perfect illustration of how innovation can just instantly threaten or even destroy old business models. FICO announced this disruptive new program. It allows mortgage lenders direct access to FICO scores.
Direct access. Okay, why is that so disruptive?
Because it potentially cuts out the major credit bureaus. Think TransUnion, Equifax. They have historically acted as these mandatory, pretty expensive intermediaries in the whole mortgage lending process.
Right, you had to go through that.
Exactly. FICO is essentially trying to go direct to lender, cutting out the middleman.
And that disruption created immediate and pretty painful market casualties, didn't it?
It sure did. The market reacted instantly to that threatened business model. TransUnion, TRU tumbled nearly 10%. Equifax, EFX fell almost 8%. Investors basically priced in immediately the significant threat that FICO's new direct access model poses to their established, very lucrative intermediary role. This is really the definition of a potential winner-take-all scenario driven purely by technological restructuring of an old industry.
We also saw some other big moves that seem to reinforce those defense tech and AI themes we've been talking about.
Absolutely. Ondas Holdings, ONDS, surged 24.69%. They secured exclusive U.S. distribution rights for 500 of these WASPA-tradable combat drones from a partner. That positions them really strongly for potentially lucrative Department of Defense contracts down the line. So defense plus tech. And then reinforcing the central theme of this whole deep dive, Resolve AI PLC, or ZLV, has continued its momentum, up another 18.40%. That came after they significantly raised their 2025 annual recurring revenue, or ARR. Guidance. And they initiated this really ambitious $500 million target for 2026 ARR. The market is just rewarding these ambitious growth targets tied to AI, sometimes almost regardless of current profitability, it seems.
Okay, on the downside, though, we saw some what looked like predictable profit-taking and maybe some deal disappointment.
Yeah, exactly. Fermi Inc., FRMI, which is an AI-focused energy startup that just recently IPO'd, and saw an 8.41% pullback. That feels like a pretty classic move after soaring, what was it, 55% on its spectacular recent debut. When the stock goes up that fast, some cooling off is kind of expected, profit-taking.
Sure.
Meanwhile, Occidental Petroleum, OXY, it fell sharply, down 7.49%. That happened after they agreed to sell their chemical division, OxyChem, to Berkshire Hathaway for $9.7 billion. The negative market reaction there suggests investors might have been disappointed with the valuation on that deal, maybe viewing the sale of what they saw as a valuable asset as being dilutive to the company's long-term earnings power. The market didn't like the price, basically.
Okay, now let's focus on what might be the most crucial psychological story of the day. Tesla, TSLA. Its shares fell more than 3%. And the decline was really striking because it happened despite the company reporting Q3 vehicle deliveries of 497,099. That number was a comfortable beat over the official Wall Street consensus forecast, which was around 447,600 vehicles. So they beat the number, but the stock went down. Why?
This is a perfect, almost clinical illustration of the whisper number phenomenon. And it's absolutely crucial for understanding how these massive AI valuations we've been discussing are likely going to be judged down the road. So for a high-growth stock like Tesla, just meeting the published analyst consensus number, it's totally insufficient. It's not enough.
Right.
The negative price action reveals that the market's actual expectation, the unofficial whisper number, was significantly higher than that 447,600 print. They expected even more.
Okay, so who sets this invisible bar, this whisper number? And why does it differ so wildly sometimes from the published consensus figures we all see?
Well, the whisper number, it's largely driven by, the fast money. Hedge funds, sophisticated institutional investors, high-frequency traders. They often have access to alternative data, real-time channel checks, or maybe just more aggressive internal models than the official sell-side street analysts.
Right.
Analysts, often for regulatory reasons or just historical caution, they tend to lag behind reality sometimes, or they're hesitant to publish extremely high outlier estimates that might look wrong later. The market, though, the trading market, it's always forward-looking. It operates based on the most aggressive, often the most optimistic assumptions that are out there circulating.
So when a company, even one like Tesla with a strong headline beat over consensus, fails to clear that invisible, much higher expectations set by the most demanding investors, disappointment hits hard and the stock sells off.
Exactly. The failure to clear that unstated but very real bar led directly to the selling pressure we saw in Tesla yesterday. And this psychology, it applies directly, maybe even more intensely, to the AI giants. The published consensus earnings estimates for NVIDIA or the implied targets for OpenAI, they might look high already. But the price action, the valuations, suggest the whisper number is perhaps 50%, maybe even 100% higher than that official consensus.
Wow.
So if these AI giants merely meet consensus when they eventually report their numbers, the result, paradoxically, could be a sharp sell-off because they failed to deliver the necessary extraordinary surprise required to justify those massive, massive valuations.
Okay, that's a really important point. Let's quickly just review the cross-asset movements from yesterday that seem to reinforce that rate cut expectation and also the sort of overall cautious undertone that seems to be dominating the market, separate from the AI bubble, maybe.
Sure. In fixed income, in the bond market, we saw continued buying pressure. And remember, buying bonds pushes yields lower. The benchmark 10-year Treasury yield eased down into a range of about 4.08% to 4.11%. And this reflects two things happening at once. First, there's sustained demand for safety because of the government shutdown uncertainty. People are nervous. Right. And second, it reflects the market's really deep conviction that the slowing economic data we're seeing, like that weak ADP jobs report, will absolutely compel the Federal Reserve to cut interest rates soon. The bond market is pricing it in.
And the commodities market seemed to confirm that two-speed market idea we outlined right at the start.
Yeah, a very clear divergence there. Gold remains strong, held near its all-time high, around $3,850 an ounce. It's functioning as that classic hedge against both political chaos and maybe potential currency debasement if we get future monetary easing. But contrast that sharply with WTI crude oil. It extended its slide, fell below $61, And that's driven by those persistent feels of a global supply glut just outweighing any perceived demand boost from AI or anything else. Two totally different stories.
Okay, so looking ahead, we've got this recent soft data, the ADP contraction, the ISM manufacturing PMI is still below 50, indicating contraction. It sets a pretty nervous stage, doesn't it? What are the crucial tests the market faces in the coming days and weeks? Assuming, of course, the shutdown doesn't completely paralyze the data flow indefinitely.
Well, the soft picture we have is definitely incomplete because of the shutdown. But the critical event this coming week, assuming it's released on schedule, will be the FOMC meeting minutes. These are the detailed notes from the September policy meeting. They're scheduled for Wednesday, October 8th. And given the current data vacuum, investors are going to scrutinize every single word in those minutes.
Looking for clues.
Exactly. Clues about the committee's internal debate. What were they really worried about regarding the labor market and inflation before the shutdown hit? Was there any significant dissent about the path forward for rates? That's what people will be looking for. We're also technically supposed to get August balance of trade data and the October consumer sentiment survey, but again, subject to shutdown delays.
And maybe most importantly, the quiet period for corporate news. It's about to shatter, right? We are heading straight into Q3 earnings season.
Yes, absolutely. The third quarter earnings season really begins in earnest the second full week of October. Traditionally, the major U.S. financial institutions kick things off, so we expect reports from heavyweights like JP Chase, Wells Fargo, Citigroup, BlackRock, Morgan Stanley, all within a few days of each other.
Okay.
These reports, they provide the next major test for the entire market. They'll offer the first really tangible look at corporate profitability under these current conditions, the slowing economy, the shutdown backdrop. And they'll help determine whether overall corporate performance can actually justify the extreme optimism that's currently baked into valuations, especially in that high-flying tech space. It's a reality check.
Okay. So if we step back and try to summarize.
Yeah, if we step back, the market action on October 2nd, it really demonstrates this compelling, almost historical moment, doesn't it? It shows the sheer power of a dominant, long-term, secular growth narrative, in this case, AI, to drive asset prices higher, seemingly completely ignoring these accumulating, very real, near-term cyclical risks. The core tension that you're investing in right now, today, is this contest between that massive, potentially decades-long AI growth story and these immediate, frustrating headwinds like a prolonged government shutdown, the Fed flying blind due to the data blackout, and an underlying economy that is visibly cooling off.
So the market is currently climbing what feels like a historic wall of worry, and it seems fueled almost entirely by momentum and just sheer faith in a very narrow group, a cohort of technology titans. The upcoming Q3 earnings season, it's not just important, it feels like it's the critical, maybe even existential test for this whole narrow AI-driven paradigm.
Absolutely. If even just one or two of those key technology leaders happen to miss expectations, or maybe more subtly, provides cautious forward guidance, that single-point concentration risk we talked about could rapidly shatter this current record-breaking narrative. It's fragile because it's narrow.
Okay, so here's a final provocative thought for you, our listener, to maybe explore on your own. Since we know from the Tesla example yesterday that the market demands a substantial beat of that whisper number for high flyers just to prevent a sell-off, how much higher must the unofficial expectations truly be for the top AI stocks? You know, the $500 billion plus giants like OpenAI or the NVIDIAs of the world when they eventually report their earnings or hit their milestones. That potentially immense gap between the comfortable Wall Street consensus and the hyper-aggressive whisper expectation floating around trading desks, that might be the single most important concentration risk to track as we head through the fourth quarter. Because if they merely deliver excellence, the market might actually punish them for not delivering an absolute miracle. Something to think about.